There's been some discussion in recent days. It's gotten a lot of attention. The idea of selling bills or letting bills run off of your portfolio to address a collateral squeeze in money markets. Is that something you think needs to be considered at this time?
Nick, as I said, I wouldn't want to speculate. Really, I'll just say we'll if conditions do change materially, we'll be prepared to use our tools in whatever way is appropriate at that time to foster the achievement of our goals.
I know a lot of this talk about inflation and interest rates can feel abstract. And so I wonder if you could put into plain language what the practical effect is of the changes the Fed has been making over the last year to your framework. What does it mean for everyday workers?
Great question. So I guess I have to say, for a long time, and when I was entering the job market years ago, when we had low employment, we had high inflation. So when the job market got good and tight, and employers were, actively seeking people, and there were plenty of jobs, inflation would be moving up, and therefore the central bank, the Fed, would be raising interest rates to cool off the economy. And I would say 50 years ago that was appropriate because there was this tight connection between unemployment and inflation. More recently, though, that I think the Fed established its credibility several decades ago on inflation, and since that time, the connection between having a lot of people out of work and and inflation under control has gotten very, very weak. So our new framework very explicitly takes that takes that in, that new learning, that new understanding, and says that we won't raise the interest rates to cool down the economy just because unemployment gets lower, just because employment gets high. We're going to wait to see signs of actual inflation or the appearance of other risks that could threaten achievement of our goals. And we've seen that the economy can sustain very low levels of unemployment without inflation. So what does that mean for job seekers? It should mean that the job market will be stronger over time. We also saw the terrific social benefits of a very strong job market during 2018, 19, and the early part of 20. We saw workers at the low end of the wage scale getting the biggest increases. We saw labor force participation moving up. So people who might have given up on finding a job found a job, and people at the margins of society, maybe coming out of prison, things like that, got jobs. And there was really a lot to like about a very strong labor market. So, we're really, really committed to getting back to a very strong labor market. And the strong anchoring of inflation expectations, the inflation dynamics that we have give us the ability to do that. But it does require that we remain committed to keeping inflation expectations anchored at 2%, and we will do that.
Of course, some prominent economists in the last couple of weeks, as you know, Larry Summers, Olivier Blanchard, are saying that policymakers have maybe grown too quick to conclude from recent decades that low unemployment is no longer inflationary. Are they right to worry about this right now?
Well, so many people, particularly people who are now entering the job market, will not have lived through high inflation. And high inflation is a very bad state of affairs, and it hurts people the most on fixed incomes and lower incomes who have less wealth to draw upon. So inflation was very high when I was in college and coming into the job market. So it's really not something we want. But I would say, at the Fed, we are well aware of the history and how it happened, and not going to allow it to happen again. It was a situation where the Fed didn't step in when it should have, when inflation pressures were building. Not at all the current situation. Inflation is currently running below 2%. It's running at 1.5%. But we're very mindful of what happened in really the 1960s and 1970s, and determined not to repeat that mistake. But you have to differentiate, though, between one-time price effects, such as things that happen around the reopening of an economy, not something we have much experience with, and just the sort of, when I say base effects, it's a technical term, you look through that, it's not really signaling anything about inflation. So, I mean, we're very mindful, and I think it's a constructive thing for people to point out potential risks. It's always constructive. I always want to hear that. But I do think it's more likely that what happens in the next year or so is going to amount to prices moving up, but not staying up, and certainly not staying up to the point where they would move inflation expectations materially above 2%. That would take, the public would have to come to believe that that's the new policy, that's the new reality. And I really don't think that, a couple of quarters of prices, or even more than that, but prices being above 2% would change the psychology, particularly in a world where inflation has been the problem for the last decade in all of the major advanced economy countries. They've been facing low inflation because of these global disinflationary pressures, which haven't gone away, and they're not going to go away overnight.
So I think our users, number one, the total size of user base is growing very rapidly, especially in the last year, and especially more in the last couple of months. We've seen much higher uptake on institutional adoption. So we have a lot more institutions coming in. They typically trade much larger sizes. We've also seen the corporate treasury coming in. Those guys have a very unique buying pattern. They buy over long periods of time, well, long meaning like weeks or months, and then they just buy and they don't sell. So, and they buy, they withdraw, they buy, they withdraw. So we've seen that pattern, which is quite new. I think probably mostly promoted by MicroSailor, MicroStrategy. Right. So yeah, we've seen those type of patterns, which are quite new.
So CC, what's the average account size? And actually, where do they make the most money from?
Actually, the average account size we have not calculated because we do have a long tail. So there are many sort of retail users with low balances. So I think the average is probably not that high. We service users from all over the world, including some of the less economically developed regions. We have accounts which holds like $100, $50, and they think that's a lot of money for them. So I think the average is probably pretty low, but the top, the big institutions do contribute to the majority of the volume.
It is a huge energy drain when we look at blockchain, or should I say Bitcoin mining.
Hi, Rish. Certainly, Bitcoin mining consumes a lot of energy, and it's been talked about in the news. One major reason for that is that it's knowable, unlike the traditional financing system where you do not know how much energy is consumed, whether it's the offices with lights and computers always running, or with the armored trucks carrying real money or physical money. So that's one reason that it's often criticized. Talking about China's recent so-called ban, it's important to note that it's not a ban yet. It's a proposed regulation by the government looking for public feedback. Whether it will be accepted or not, we do not know yet. And they plan to implement this if it is put into effect by end of April this year. Now, it's important to note when it comes to implications of this ban that Inner Mongolia is not the top province in China for mining. And this is not the first time that the Inner Mongolian government has tried to restrict mining in their region. Last year in August, they made some change of policy by which they took away the perks of electricity to 21 Bitcoin mining data centers. So I do not foresee this having bit broader implications on the cryptocurrency mining space.
Okay, Nishant, do you think, though, it leads to a full ban across China? And what would that mean for China's role in terms of that centrality that it has in the mining space?
That's a good question. So I do not think this is indicative of a nationwide ban yet. However, it is surely indicative of China's lack of reliability when it comes to Bitcoin mining. And thus, as Bitcoin becomes more institutional investors, especially in North America, are very bullish on Bitcoin mining in North America, not anywhere else. So they are trying to grow this ecosystem in North America rapidly since about a year now. And in the last 1 year, we have seen China's share of the global Bitcoin mining computing power decrease from more than 72% to less than 65% now. And I estimate that end of this year, you will see China holding less than 50% of the global computing power of Bitcoin. That's as a result of this institutional interest and also an interest by institutional investors to decentralize Bitcoin, which is a very important value proposition of this digital gold.
So Nishant, you touched on the US there as a potential beneficiary of a migration out of China. Then, which other nations are best positioned to take up the slack when it comes to the mining?
It's a good question, Tom, because it's not just North America. Because of lack of resources to power renewable energy for Bitcoin mining, there's a lot of interest in renewables. And so Russia is coming up as a top country also alongside North America for Bitcoin mining.
Nishant, you used an interesting phrase, the decentralization of this. What do you mean by that? And how is the composition of the people who are investing in Bitcoin, which you also been touching on, changed profoundly since the last rally that we witnessed?
That's a good question, Rish. Now, talking about decentralization, so Bitcoin's value proposition, a very important one, is that it's decentralized, which means it's peer-to-peer. There's no central authorities that can manipulate the price or control issuance, etc. However, that is challenged when the backbone, which is the computing power powering Bitcoin globally, majority of it is in one single country. Right now, 65% or more is in China. And that makes investors in Bitcoin, especially institutional investors, quite concerned about Bitcoin's reliability in the long term. And thus, there has been this push from North American investors to increase North America's share of Bitcoin mining. And that has been going very well. As I mentioned, I really expect that China will have less than 50% of the global computing power of Bitcoin by the end of this year. Now, talking about, what was the second question, Rish?
It was about the way that people are investing and how it's changed from the last rally that we saw in Bitcoin.
Yes, that's a very relevant question, especially now that we are seeing Bitcoin flirt with its all-time highs. That's because during the last rally, which happened in 2017, it was mainly driven by retail investors in Asia. And this time, it's very different because it's driven by institutional investors in North America. You have companies like Tesla announcing some kind of corporate treasury in Bitcoin. You have various other publicly traded companies in USA announcing allocating some part of their corporate treasury to Bitcoin. So we are seeing a lot of things changing across the board in the Bitcoin mining industry and the Bitcoin industry.
Nishant, we have to get this question in, probably our last question. It's around $51,000 now for Bitcoin. What are the catalysts for the cryptocurrency going forward, do you think? Is it that the additional kind of industrial buy-in? And what is the key? Is there one key regulatory risk that you have to have on your radar?
So right now, I don't see any black swan event coming up because they're black swan events, Tom. I only am bullish at this moment because institutional investors are it's like a trend for institutional companies in the US to announce that they have invested in Bitcoin or Bitcoin mining. And this trend doesn't seem to show any signs of stopping anytime soon. As more institutional money is poured into Bitcoin, I only see the price going up. However, when talking about some expected events that could tumble the markets, it could be some regulations by the US government to restrict trading in Bitcoin. What that could be, we do not know.